Howdy, Jacob here. Today we're looking at Meta Platforms, formerly known as Facebook. I would presume you know them. They own Facebook, they own Instagram, they own the Oculus, I believe, headsets, the reality stuff. They own WhatsApp, quite a bit of the social media realm, just a little bit of it, I guess. Yeah, 1.2 billion market cap, a little bit less enterprise value. They just started paying a dividend at $2, which is 0.4% on a dividend yield basis. If you're looking just to 2021, the previous 8 years, the smallest growth was 21% during COVID. And then you do see negative growth in 2022, but it looks like they're getting back to some pretty hefty growth here. Earnings grew substantially, revenue stupendously. Return on invested capital is now in the low mid 20s, huge. Operating margins actually down a little bit from 10 years ago, but is in the pretty consistent range of 35 to 50%, really. I guess it's not really that consistent, but in a decent range on operating margin, gross margin, 80%, very substantial. Balance sheet shows 41 billion cash on hand, 23 billion in short-term investments with long-term debt of 18 billion. Balance sheet extraordinarily healthy. They have current assets 85 with 76 total liabilities. So no concern on the balance sheet as expected. It's one of the I can never remember the name, but one of the big seven companies that's just going absolutely wild. Funny enough, when they drop down like crazy from this high of 380. I'll say again, short term, I've done a video on this, doesn't mean that you're right. So even buying at 93 and then being at 500 now, it makes you look right. But if you don't do the calculation of how much it's worth, just looking on a stock ticker price history, it doesn't tell you you're right. But I will say, this is probably one of my biggest gains where I was starting to buy probably right about 200 and then got as low as I don't think I bought 90 or whatever, probably high 90s when I was dollar cost averaging down. But um, yeah, just it's been on a just crazy blink. 90, I think it got as low as 90, 89 maybe, and it's now 500. I believe it's been to 500. Let's see, 520. Holy smokes. They've just been on an absolute bender here. But again, you can't look at this and see whether you're right, wrong, this, that, the other. You have to calculate what it's worth and then put your own safety and margin in to see when you would be most comfortable purchasing it. So we see free cash flow, pretty substantial. They were huge reinvestments, why their capital expenditures have been going up so much, but their cash from operations are also going up pretty hefty. Use of cash, a lot of share repurchases, and reinvesting back into themselves, making a good amount of acquisitions, but in relation to cash flow, pretty insignificant. So use of cash, pretty heavy on reinvesting, pretty heavy on share repurchases. So let's start making some assumptions here. Revenue growth, they are one of the smaller ones from a revenue perspective of the big seven. Um, but advertising revenue is not entirely there. I don't know how they've capped out all of their platforms. So I do think there's a good amount of growth there. Maybe let's do 10%. Um, I don't know if I'd say they necessarily have the same moat as maybe an Apple or a Microsoft or an Amazon, even Google. I mean, them and Google do similar things, but I feel like Google does a better job of. I don't know. They both do a fantastic job. I'm not even going to say that. Meta and Google both do fantastic jobs of with their ad revenue and such. Um, Dividend, they just don't have as much of a history with it. They just started paying it, and to be honest, I don't know if I'd want them to really increase this dividend. They I would want them to be reinvesting at these 20% rates of return that they've been able to do historically and then buying back shares when it's most advantageous. Again, not saying they're right, but if we do get if they were doing present value of their company, they should have been buying back the most stupid amount of shares, sub, 150, $90, whatever, to where if they thought this company was going to give you a 10+% return at 300, over a 10, 20-year period, for it to fall to 200 or 100, they should have been buying back as much as possible. But again, the graph makes it look a lot better than it might have been. Like maybe they hovered around 100 for a little bit. You never actually know. Maybe they wouldn't have had as good of growth this quarter in both revenue and earnings. So hindsight's always 2020. But get back to making some assumptions here. So 30, 28. I'll probably do something along those lines. 32 to 30. Maybe they buy back 2% of shares. Yeah, I'm saying it needs to fall a little bit more. So I think it's a great company. I mean, it's part of the Big Seven, whatever they call it, Magnificent Seven. I mean, if you look at 280, looks like they were there a year ago. So I don't think that it's too astounding to me with the numbers that I'm looking at. I think that this is a pretty, I don't want to say conservative, but I think it's a very reasonable assumptions here, and makes sense why I was buying under 250 personally back then. But as of right now, yeah, just not quite at the prices that I'm looking for to get the maximum return that I'm into. So hopefully you enjoyed the video. Have a great rest of your day, and thank you so much.